Hey everybody, this is Ryan Mallory. I'm going to do a stock market update for you here, not just on the S&P 500, but I'm going to get into a whole host of other stocks as well. I'm going to get into the NIO stock, the Tesla stock. We're going to get into the vaccine stocks like Moderna stock and the Pfizer stock. I'm going to get into the Halliburton stock for an oil play, and then some of your high flyer stocks like the Sonos stock and the RIOT stock. So let's go ahead and get into that right now. Now, we got to remember, this is Thanksgiving week. That means the market is only going to be open on Monday, Tuesday, and Wednesday as full sessions. Thursday, it'll be closed. And Friday, it'll be open for a half day. On top of that, 51 out of the last 67 trading sessions have been bullish for the stock market on Thanksgiving week. Holiday weeks as a whole tend to be pretty bullish as well. So history's on the side of the bulls. Doesn't mean that the bears can't eke one out here, but historically speaking, it's not as likely to happen. Now, there could be a few roadblocks that cause a little bit of problems for stocks in the week ahead. First of all, you have the COVID numbers spiking. That as a result is seeing states like New York starting to shut down again. If you see more and more states follow suit, you could see the market start to react more and more violently to the downside. As a result, stimulus talks start to come back into the picture if small businesses are shutting down. And so far, between the Republicans and the Democrats, there's no middle ground being reached. So if that stalls out, the economy stalls out, we could have a whole other problem on our hands. But let's focus on the week at hand here going into next week. Now, what are we looking for in the week ahead? Well, the S&P 500 finished 0.8% down on the week. The NASDAQ finished up 0.2%. So you started seeing a little bit of a rotation back into tech stocks this past week. It didn't affect the small caps too bad, but the S&P 500 did finish lower. We are sitting right at all-time highs. Over the past year, there's been a pretty strong resistance level that's not been favorable to the bulls in terms of breaking through it. That goes all the way back to the February highs. It goes all the way across. It touched it 2 weeks ago, but it's consolidated underneath it. And that's actually a good sign for the bulls. Even though it hasn't managed to break above that resistance, it's not selling off dramatically as a result. What we saw back in September and what we saw back in February was dramatic sell-offs. Now, this is all part of a bigger resistance level going all the way back to 2012. And every time it's been tested, it has resulted in dramatic pullbacks. But this time around, we haven't seen that. The only concern that I have is that when you zoom into the price action going back to October, we started selling off gradually in the beginning, and then we saw a hard sell-off towards the end before finally bouncing. Right now, we're not even selling off that much. We're just kind of turning sideways. But my concern is in the week ahead or the week thereafter, maybe we start to see that selling pick up. And if as a result, you want to be liquidating those long positions so that you don't lose all the profits that you made for the month of November. The double bottom still in play. It's confirmed it. It's consolidating since confirming it. But it's going to be on the shoulders of the bulls to really break out of this consolidation pattern that we've seen the past 2 weeks and push to new all-time highs. But in doing so, it's going to have to break that resistance, and it has yet to do that. Now, we've seen the oil stocks, the financials, and industrials really pick up some steam in this past couple of weeks here. They have been the leaders of the market. My favorite play, and I'm long on it right now, has been Halliburton. I got long on it back on November 13th at $14.37. It's gone up quite well ever since then. I like that double bottom and the bull flag that it made. Once it broke out of that bull flag, I took a third of my position off for a 5.3% gain, and then I took off another quarter position. So I'm basically left with a half position at this point in time. You have a lot of resistance between 1645 and 1695. It hasn't really tested it yet, but if you're looking for a secondary breakout on Halliburton, this is an area that I would probably target if it can break above that 1692 level, because then there's a lot of room to run up into the low 20s before it really runs into any major resistance. But if it starts to get into the mid 16s and it can't break through, then I will start to liquidate a little bit of my position even more, maybe take it down to a quarter position and see if it can't run back up into the 20s. Now, how about Sonos? Well, I don't really think this was a playable trade this week. What you really need to do is be patient for the stock. First, you had this huge resistance that it cleared this past week here, but it wasn't really playable at that point. The reason why is because it was in this massive basing pattern for pretty much the entire existence of the stock. It's just been in a sideways channel. Finally broke out. It's nearing a test of its all-time highs. Now, what you want to do is probably wait for it to come back to this breakout level where it would start to fill this massive gap higher from this past Thursday, and in doing so would give you a nice bounce opportunity. But right now, if you're chasing this thing above 20, you're absolutely exposing yourself to incredible amounts of unmanageable risk. And unmanageable risk is really what we want to stay away from, because you're getting gaps higher and you're getting gaps lower. A lot of it's headline risk, but you can't control it. For me, if I'm looking to get long on this thing, I want to see this thing pull all the way back down to at least $18 before I take a long position on it. Now, if it goes up to $25, $30, $40, I don't care. There's always another trade out there, and that's what we have to remember as traders. Now, how about the RIOT stock? I would probably avoid this one altogether. If I was interested in playing the whole Bitcoin phenomenon, I'd probably just get into Bitcoin, not RIOT. This thing back in 2017 went completely parabolic. And then it had this massive pullback that left a lot of bag holders and a lot of people with massive gains that turned into massive losses. Now, obviously, you're seeing the same thing start to sprout up again, but if it's me, I would avoid the whole RIOT stock that sees these dramatic lifts higher and then these dramatic falls lower. Now, before getting into the Tesla stock, I want to tell you about my YouTube channel membership here. This is one of the best things that you can sign up for. You're going to get all of my market research each and every week. That's going to include multiple updates on the S&P 500, the NASDAQ, the Russell. You're also going to get an update each week on all of the FANG stocks. That's going to include Facebook, Apple, Amazon, Netflix, Google, and as a bonus, I'm going to give you the Tesla and the Microsoft updates, followed by my personal watch list. You can get all my bullish watch lists, my bearish watch lists updated multiple times each week, as well as the charts of the day that I find the most interesting and intriguing from technical analysis standpoints and trade setups. So check that out, click the join button down below and you can get all the information for that. Now, how about the Tesla stock? Well, I talked about in one of my previous videos that there was a nice secondary breakout play. Got that secondary breakout play, it's pushed higher, it went over $500 from the 462 that I had talked about. And the best thing for the bulls here is if it could do a little bit of consolidation, maybe a bull flag, maybe just like a triangle pattern. There is the potential that if you take the peaks from early September until now, maybe that's a double top. I need to see more price action before I really get behind that. Nonetheless, if you're still desperate to get into it, well, I don't know what to tell you. Maybe there's another secondary breakout once it clears the September highs and closes above them. That's the next play. Now, the NIO stock, well, guys, you guys just got to chill on this NIO stock here. Some consolidation over the past few weeks. Wouldn't be surprised to see it go higher. I don't see a genuine risk reward on this trade that doesn't require at least a 20% risk. That's a little bit too much for me. That's assuming that there's going to be another 40% of upside to the stock. It's already parabolic. I want you to look at this trend line going all the way back to June, late May. It has consistently bounced off of this trend line. Now, the big question is it going to pull back to this trend line? What I have seen time and time again in so many stocks is that when stocks get this disattached from its existing trend line, it has a dramatic pullback lower, and that's what you don't want to be in if that happens. So the risk for me becomes if it starts breaking below $40 a share, that's going to be a huge red flag for me. But even so, there is a little bit of a triangle pattern action that's going on here. The best thing that NIO can do is continue to consolidate for the next week or two before making that next leg higher if it chooses to do so. By doing that, you have a more legitimate risk reward setup, but right now I just don't see that without putting more than 20% of your capital at risk on the trade. Now, how about Pfizer stock? They were the vaccine plays from a couple of weeks ago. It had this huge spike, but since then it's faded that initial move and it's consolidated. Look, you have this huge declining resistance going all the way back to late 2018. It finally broke above it with that news, and then it's been consolidating just above it. So it's really not a bad play if you take the lows of November 16th as your stop loss, followed by a breakout above the week's highs. Very possible it gets back up to 40 and maybe even a push up to $42 or $44 a share. I like the volume that's pouring in. It's all above average. Vaccine plays are a huge interest to Wall Street right now, so keep your eyes on this particular one. I also like the inverse head and shoulders pattern that has been forming over the past year. That's been confirmed. The neckline's broken. Very good chance that we see higher prices out of PFE in the year to come. Now, the higher risk play would be Moderna. This was this week's stock market vaccine of the week. I do like the fact that it's trying to consolidate after that huge Monday gap higher, but it needs to form more of a bull flag before I could even consider it. The big downside risk to this stock is this rising trend line off of the March lows. You can see here that it has become quite disattached from this trend line, and yet it still has a history of wanting to retest it. So the potential is there for a little bit of a pullback to this breakout level here. So that's the downside risk. That's why I consider Pfizer to be the less risky play versus Moderna, which has a much more higher risk ceiling to it. If you like this video, I'd encourage you to like and subscribe. It does wonders for me to grow this channel. It means a lot to me. It inspires me to continue to produce this great content each and every week. In the comments below, tell me which of the stocks that I've mentioned that you're long in. If you have one that you want me to check out, let me know that too, and I'll try to see if I can add that to one of my videos for next week. I look at all your comments, so make sure to leave your feedback down below. Thank you guys, and God bless.